Hello, I'm Loda Smits for the Finance News Network, and joining me from Antares Fixed Income is Portfolio Manager Tano Pelosi. Tano, welcome back to FNN.
Thank you, it's great to be here.
Antares cover the spectrum of domestic fixed income markets. How have the funds been performing this year, and what have been the drivers behind that performance?
The funds have actually performed quite strongly this year, particularly in a relative sense against the peer group. Certainly long positioning credit has certainly helped excess returns, particularly with the roll down and the carry. And unlike previous episodes where yields have pushed up, the credit has been fairly resilient.
So Tano, what do you think are the key challenges currently facing bond investors?
Well, we think there are three factors and three key challenges. Firstly, there's an interplay between structural factors and cyclical drivers. And what we mean by that is that there are secular forces that are interplaying with the current cycle that are impacting on growth and inflation in ways that are not particularly well understood by the market. The second is at what point do investors start to unwind QE trades that have been built up over the last 6 and 7 years as central banks have engaged in quantitative easing. And the third is essentially, we're at rock bottom yields here with respect to bonds, and there is a high probability that returns will be negative going forward. So what role does bond investing play going forward?
Now, bond markets globally have seen a dramatic sell-off over the last month. Some even fear we may be at the beginning of a major bond rout. What factors, in your view, are responsible for the recent bond sell-off?
I think the bond rout, at least the bond sell-off, has more to do with 2 or 3 factors, such as fading deflation risks, particularly as oil prices have rebounded of late. Some evidence that the European economy is starting to get on more solid footings. I think positioning with respect to investing, bond investing, has been squared up, particularly after a long period of duration build-up. And thirdly, there's a growing recognition that bond returns are likely to see a period of negative returns by virtue of the fact that we've had a great stellar performance. Internal rate returns have been driven down and yields are now at rock bottom levels.
And Tano, what do you see as the key risks for rates going forward?
There's 2, basically the Fed and market positioning. One is a little bit harder to determine than the other, and by that I mean it's a little bit hard to gauge to what extent long duration has been built up over the last 5-6 years as a result of QE trades. But we can get a better guide or gauge on when the Fed will engage in lift-off with rates. But what's not so clear is how the bond market will react once we have lift-off in rates.
Okay, and Tano, when do you believe the US Federal Reserve is most likely to lift rates?
Well, when they're likely to lift rates and when they should, I would argue probably not the same thing. I think they generally acknowledge that rates are highly accommodative, and by any measure, any Taylor rule model would suggest that rates are very accommodative, even to the point where they probably should be closer to 1% rather than 0. So, that as a backdrop would suggest that they should move rates sooner than later, just given the starting point. So I think the data continues to be quite weak, but the starting point with respect to rates is so compelling for them to lift rates soon that we would suggest it's going to be in the next 2 or 3 months.
So what is your assessment of the current state of inflation?
I think it's true to say we've been on a roller coaster ride with respect to inflation, shifting or oscillating between deflation risks and inflation risks. But all along we've thought the risks have been binary. The economies globally are still vulnerable to external shocks, hence the deflation risks, but central banks are acting in a way that is encouraging inflation risk, reflating, so to speak.
Finally, Tano, earlier you touched on the more challenged nature of future bond returns. How do you think investors should view the risks surrounding future bond returns?
Bonds still play a pivotal role in portfolios in the sense that they cover off on some of the binary risks I touched on earlier, particularly if we're not out of the woods with respect to deflation. Historically, bonds have performed tremendously in deflation periods.
Tano, Pelosi, thank you for the update from Antares Fixed Income.
It's a pleasure.